We have a company, Patriot Theaters, that owns and operates movies throughout the Mid-Atlantic region. And the managers have found an opportunity that they're thinking about doing. They think that expanding into New England might be a good move, might be something that could increase the firm's value and be a move that would be in the best interest of the firm and its shareholders. How can they make that decision? And the way that they can is to conduct capital budgeting analysis to help them make that decision. So that's, the company's thinking about doing something. They conduct the kinds of analysis that is discussed in this section to help decide whether or not it's a good move. So the process is largely about how a firm decides how it's going to spend its money. And particularly we talk about projects, which are generally long-term investments that are expected to be beneficial. So a couple of examples would be, buying or building a factory to increase production. So you have a company that makes shoes and the shoes are really successful, so they need to build a new factory or buy a factory or expand on the existing factory so they can make more shoes than they've been making. Opening stores in a new region. Company sells shoes in the US and they have been incredibly successful, so they say let's go to Europe or Latin America or Asia or Canada. Again, same thing, a new product or service. So again, this company offers shoes, it's really successful. It says let's go with a full service clothing line. So they buy equipment and they buy facilities so that they can make pants and shirts and all other kinds of things, shoes. Well, they already make shoes, jackets, capitalizing on the name. So these are examples of some kinds of projects. A big study of projects is looking at cash flows, and so we can break it down into two types of cash flows, expected cash flows. One, investment related. And again, those are the cash flows associated with making the investment. And so it's basically buying the building, building the factory, buying the equipment to help facilitate expansion overseas. And these are almost always negative. You're paying out money to build something or buy something or make something, particularly a big piece of equipment or a factory or something big. Second kind of cash flows get referred to as project-related expected cash flows, and they're the cash flows produced by the project. So here, this investment, that might be the money to build a factory. Project-related is the cash flows associated with using that factory to make and sell products. And these can be negative, zero, or positive. And again, think about it could be positive because you make lots of product and you're able to sell it at high margins, and so the cash flow associated with operating the factory is positive. Likewise, the cash flow associated with operating a factory could be negative. You've got this big space and you're paying electric and heat and you're paying salaries and raw materials, and you're just not able to sell a lot of goods, and as a result it's hemorrhaging money. And it could be exactly zero if everything just matches up. So this is important because we're going to be looking at a pattern called conventional cash flows. Products can have any pattern. So when we talk about conventional, it's not this is a good pattern, this is a bad pattern. But it's important to understand what a conventional cash flow pattern is, because some of the measures that get discussed and get used in capital budgeting are really only relevant if cash flows are conventional. If they follow a different pattern, it's not necessarily that it's bad for the project in any way. It simply means that certain measures cannot be used without making special adjustments. So what are conventional cash flows? First of all, at time zero, there's a negative cash flow. And the reason there's a negative cash flow is because this is when you have your investment-related expected cash flow. At time zero, the firm, the investor, spends the money to make the project happen. It's the only time investment cash flows are made. It's the only cash flow that takes place at time zero is the investment, and it's the only negative expected cash flow associated with the project. And so when you say, well, a project requires an investment of $1 million, that's saying that the cash flow at time 0 is negative $1 million. What happens at time 1, time 2, time 3, however long the project is going? Those cash flows are non-negative, expected to be non-negative, and at least one of them is expected to be positive. So again, you can see that, and again, these are all project-related cash flows. So again, here we spend money to make the project happen, and here we have project-related cash flows. And again, in reality, project-related cash flows don't have to be positive. They can be negative. But when we're talking about conventional cash flows, this special pattern, then these cash flows are all non-negative. They're all at least one of them is positive. If you had a project that didn't have conventional cash flows, it's any pattern that's not conventional. A couple of key cases would be that the cash flow at time 0 would be positive or 0, or you have a negative expected cash flow at time 1 or later. And again, nothing wrong with this. You may have a project where you spend money at time 0, then you have 3 good years, and then in the 4th year requires a lot of renovation, so it's negative, and that's just not a conventional pattern, but it doesn't necessarily mean that it's a bad project. It simply means cash flows aren't conventional, and certain measures shouldn't be used when evaluating it. A couple of notes. Basically, if cash flows look conventional, then they are conventional. So if you have a case where you have a negative cash flow at time 0, and then after that everything is 0 or positive with at least one positive, call that conventional. You don't need to start thinking, well, it's negative here, but maybe part of that's project related, and this is positive, but it could involve a lot of different things. If it looks conventional, it is conventional. Also, what are we going to look at? When we evaluate projects with NPV, quantitatively evaluate them, meaning compute NPV and make a decision, they may not all have conventional cash flows. When we look at other methods besides NPV, and we figure out a measure and make a decision, they will all have conventional cash flows. There's issues with these other methods where if they're not conventional, it creates problems. That's important to understand. It's important that the other criteria can't be used without modification if you're dealing with cash flows that are not conventional. Again, we'll talk about it, but it's important to know. And again, you can make adjustments and actually apply those other methods, but that goes beyond what's going to get discussed in this class. It's important to recognize it. It's important that if someone who's doing financial analysis brings you a report, you can recognize some of these issues to say, oh, it looks like that was an appropriate kind of analysis for this situation, or it wasn't. So there's a lot of elements to the whole process. You identify potential projects, you have to forecast the relevant financials, you have to analyze those financials, you have to go through a whole bunch of different steps. In this section, we're going to be looking at the decision. Particularly, we're going to look at different measures and apply them to basically make a simple yes or no decision. So we have projects, there's no constraints, you can get whatever money you need, there's no mutually exclusive choices. It's not a case, well, if I do this, I can't do this, or if I do that, I can't do that. Each project's evaluated on its own, simple yes-no decision. And finally, all the relevant periods are assumed to be a year. The material, if you are in a business like the Halloween store or the July 4th fireworks stand, where it might, they're seasonal in nature, and so looking at things on a quarterly basis makes sense. Everything is relevant, except you would just have to sometimes annualize things. We're going to assume everything's a year, so we can focus on the capital budgeting issues and not on any kinds of annualization or time period issues. And the way we're going to approach it is we're going to look at 4 different measures: NPV, IRR, payback, and discounted payback. And each of these, you find a number, you use that number to make a yes/no decision, and we'll also talk about strengths and weaknesses for all of the 4 measures.